Okay, everyone. Good afternoon. I'm very happy to be here, and I want to thank you, conference organizers, for giving me this chance to talk. I'm very sorry to change the title a little bit. So the topic of today's talk is competition and complementarity in the market for cryptocurrency exchanges. I'm Junyi from Fudan University, and this is a joint work with Professor Anthony Zhang at the University of Chicago. So suppose you want to buy a cryptocurrency like Bitcoin, Ethereum, and some other kinds. It's very general for investors to trade against a cryptocurrency exchange like Binance, and there is a screenshot from their website. So basically, they advertise that you can buy, trade, and hold different kinds of cryptocurrencies on Binance. So the general purpose of buying crypto is that you should be able to transfer your money on the crypto exchanges, and then you can try to trade the crypto against other people using the money. And there are a bunch of crypto exchanges. For example, if you are in the United States and want to trade crypto, you might deal with Coinbase. And there are also Huobi and Bybit. And here is a whole list of cryptocurrencies for you that you can use. So the basic question of this project is that we want to analyze the market structure of the cryptocurrency exchanges. So more broadly, we want to ask why the cryptocurrency exchange market structure is this fragmented, given that they essentially trade the same set of coins. So if as an investor, I can engage in this market and trade the same set of coins, regardless of which exchange I can choose on. So why, nevertheless, there are so many crypto exchanges? In particular, we want to ask if it is the case that there is only a fixed volume of traders and the exchanges are fighting for who trades on which exchange. Then why don't the big exchanges just absorb the smaller ones and the market structure become more concentrated? Another question is how influential these large exchanges are. So do the big exchanges have the ability to shape the market outcome if this market structure seems pretty competitive? So that's with this motivation, I will just first introduce a number of starlight facts. So by expectation, the large and the small exchanges, if they are in a classical oligopolistic market, they should be competing in the manner that they appear basically to be substitutes to each other. So it means that after exchange entry, for example, say that Binance decides to list the maker token, they will cannibalize the trading volume of the small exchanges. So, for example, if the small exchanges, when Binance lists the maker token, should lose their trading volume to Binance because there is a large competitor in the market. Also, after the large exchange entry, we should also expect that the small exchanges will be less likely to enter the market because there is already a large competitor. However, what we find in the data is exactly the opposite from these two previous expectations. So what we find is that the large and the small exchanges appear to be economic complements rather than economic substitutes. So what does it mean? It means to say that Binance is the maker token. The small incumbent exchanges experienced an increase rather than decrease in their trading volume. And in terms of other exchanges behavior on the way that the small exchanges on the large exchange listings, we also find that the large exchanges, the small exchange listing will follow the large exchange listing behavior. So it means that the small exchanges perceive they are going to have a higher profit after Binance lists the maker token. So a hint on the mechanism that we think might drive the results is that we also observe that the price dispersion across the exchanges decreases after the Binance lists the maker token. So with this data and the facts, we like to build a model to explain what we think is going on here. So the model basically features two things. First, it has the periphery of small exchanges with captive customer bases. So it means that the customers on the peripheral exchanges don't have a substantial ability to migrate to other central exchanges like Binance. So for now, we're going to talk a little bit more about how we might think this captive customer bases might come from. But for now, I just assume that there is captive customer bases. And we are also going to assume that the small exchanges interact with the large exchanges by arbitrage. So the liquidity provided on the small peripheral exchanges is partially provided by arbitrage between the deep core exchange and the smaller exchanges. So for the world in the model, what is happening is that suppose there is a small exchanges in some places like in Philippines, and it figured out how to work with the local banking system and how to work with the local jurisdiction system. So so it allows the customers to trade the maker token, for example, but Binance can do that. So at this time, the small exchanges essentially function as the costly window to the deep liquidity available on Binance. And so how does this model explain our results? So we find that the small exchanges in the model should experience a higher volume increase because what happened after Binance, for example, the maker token is that they decide that the small exchanges, liquidity shocks on the small exchanges tend to arbitrage into the deep liquidity available on Binance and generate a higher volume. So it also means that a higher profit, which depends on volume in our data, in our model. So that means that the smaller exchanges and the incumbent exchanges will also follow the listing decisions of the Binance. And the Binance decision have a very large listing effect. So basically, we tested the model's predictions empirically and also proposed some other predictions. So what's the policy implications of our results? So basically, we paint a picture that there are a bunch of small exchanges. They don't effectively compete with the large exchanges like Binance. Otherwise, they consider the large exchange listings as complements to their products. So the small exchanges act as costly windows to the big exchange liquidity. And one main question, why do we like that? So the small exchanges, they charge higher fees and spreads for the service to the access of Binance. So one could argue that if just every investor trade on the same exchange and the market become more concentrated, would the equilibrium welfare of consumers become better? And another implication is that the big exchanges play a systematically important data role, a role which is understated by its market share data, which I will present a little bit later. So this market seems pretty competitive at the first glance. So the market share of these large exchanges is non-trivial, but still modest. And there are a very long tail of small exchanges. So why don't, so it seems that the small investors have a lot of choices. But it turns out that these choices are very fake. So actually, these small choices, they just follow the listing decisions of this big guy. So for example, when Binance decides to list the coin, the incumbent volume increases, and the other small exchanges decided to list to follow the listing decisions of Binance. So we quantified the effect and gauge that for each $1 trading volume generated on the central exchange like Binance, how much extra dollar can be generated on other exchanges like these incumbent and the new entrant exchanges. So the figures are 0.7 and 3.6 for Binance and Coinbase listings respectively. Okay, so there's the literature slide. I will just give it for the read on time. And let me get a little bit of the background. So what is a crypto exchange? So the crypto exchanges allow customers to buy, sell fiat for crypto. So if I want to buy crypto, like Bitcoin as an investor, what I should do is that I should deposit fiat through the bank transfers and buy Bitcoin against other people using my deposit and withdraw my crypto to my private wallet. Or I can do eventually the opposite thing. I can deposit my Bitcoin and sell them out and finally withdraw the fiat. And there are various reasons for people to trade crypto. Some people consider crypto as a store of value and dodge the capital controls. Some people want to participate in the decentralized finance or do the price speculation. So this is a basic background, but our analysis is not dependent on each of these activities consisting which fraction of the total use of crypto. But it's worth noting that crypto in the exchanges in the crypto world play a much larger role than exchanges for the traditional assets. For example, if I want to buy stocks from the New York Stock Exchange, what the exchange do there is that they don't handle your assets. They just handle the custody and oversee the speculations. But the exchanges in the crypto world actually act as a very large, bigger role. So it can be considered as a FX dealer. So crypto world, people buy crypto for the certain use, as the people buy foreign currencies and to do, and these intermediaries need to provide certain services like the international remittance. Also, crypto exchange is vertically integrated with other entities in the crypto world, like venture capital, other applications like blockchain protocols, stablecoins, derivatives, and leverage. So from this perspective, the exchanges can be considered as the universal banks of the crypto world. And we think at this stage, this entity is understudied, so that's a broad set of our motivation also. So the market structure of the crypto exchanges is very different from the equity exchanges. So the US, there are roughly 10 equity exchanges, but for the crypto exchanges, there are a large bunch of crypto exchanges, and most of them trade the same assets. Although you can see that they often serve different countries, but even within one country, there are still many different crypto exchanges. And their market share is also non-trivial but modest. For example, for the top two exchanges, Binance and Bitcoin, their market share of trading volume consists of 15% of total trading volume even in 2022. So that's a lot of very high number. So these results just suggest that this market seems pretty competitive, but next we will show that the large exchanges in the market have a very large role understated by its market share. So the data we use in the paper is the open, high, low, close price and volume data from cryptotick.com. So basically we have the daily price and volume data for about 200 exchanges and 12,000 coins. And we restrict to the sample to the top 500 coins on September 3. The listings are a very important part in our analysis, and we identify the listing times through the very first time the coin trades on an exchange. And we treat the two largest exchanges at present, Binance and Coinbase at large. So let me give you the starlight facts. So as I have already mentioned, for example, when Binance decided to list the Maker token, what will happen? First, the incumbent exchanges which have already listed the Maker token should experience the increased trading volume. And other exchanges which haven't listed the token should have increased the propensity to list the same token. So we think the results that may drive this result is that we also observe the price dispersion decrease after the large exchange listings. So for the first facts, we estimate a dip in dip specifications at the coin exchange and the time level. Essentially, we regress the log volume on the coin exchange peer fixed effects, the time fixed effects, and a series of studies indicating the listing time difference between the observational date and the central exchange listings. So essentially, this specification, for example, Binance decided to list the Maker token. We compare the log volume of a Maker on each exchange with the other coin exchange peers volume that is not affected by the listing Maker of Binance. So this is a result. What you can see is that right after the Binance and Coinbase decided to list their token, there is a spike in trading volume. Although it's a sort of short period and decay quite rapidly, but this figure still suggests that the large exchange listings do not cannibalize the trading volume of the small exchanges, but they actually increase the trading volume of the small incumbent exchanges. And for the tension effect, we also show that the large exchange listing is associated with other exchange following listing the same coin. So this is a histogram of the small exchange listings. And the axis is a relative listing time difference between the small exchanges and the central exchanges. So basically what we see that right after Binance and Coinbase list the coin, another of those small exchanges just decided to list the same coin. And this also holds in the regression form. So if we regress the number of exchanges on the same set of variables, which and we see that right after Binance and Coinbase listed the token, the number of exchanges just increased dramatically, and this effect is quite persistent. So previously the result, so the trading volume result is quite a short-term period. And we argue that this is because that the other small exchanges decided to enter the market and compete with the small incumbent exchanges. And the third effect is that we found the price dispersion decrease after the central exchange listing. So what we find is that so this is the interquartile price dispersion around the central exchange listing. What we find is that after the large exchange listings, the price dispersion decreased a lot. And this also holds in the regression form. So I don't have much time, I think, so I will only give a very simple model overview and introduce the model insights. So basically, there are many peripheral exchanges with captive customer bases. What we might think the captive customer bases might come from is that, for example, the small exchanges in Philippines figured out how to deal with the local banking system. For example, they could also advertise aggressively for the local customers, and Binance can do that because of some reasons. And there is a large, deep, infinitely central exchanges and their prices can be moved by any entity or shocks. Also, there are arbitrage between the small peripheral and the large central exchanges. So basically, there will be some shocks on the peripheral exchanges, and the customers on that exchange will face to idiosyncratic liquidity shocks. But the limit to arbitrage means that the liquidity that arbitrageurs cannot smooth completely to the price shocks, and the liquidity shocks can move prices. So what will happen in the model when central exchange lifts? First, the peripheral exchange volume will go up due to this arbitrage channel, and the other participants in this market can anticipate this volume increase and the higher profit. So these peripheral exchanges will also be more likely to lift. And due to this arbitrage, the price dispersion across exchanges will also decrease after the central exchange lifting. So basically, there are 4 agents that have introduced the central exchange. Their prices can be moved, and the peripheral exchanges, there are a number of customers on the peripheral exchanges and the trade due to the liquidity shocks. And there are finally the arbitrageurs. They will arbitrage between the peripheral and the central exchanges, also subject to some inventory costs. So I will just use some figures to illustrate this model. So basically, if we assume that there is an aggregate negative inventory shocks on the peripheral exchanges, and more people want to buy the token than people to sell the token. So we just compare the equilibrium outcomes in 2 scenarios: the scenario with and without the central exchange. And then we first consider the scenario without the central exchange. So what will happen is the basic income 101 course. The price on the peripheral exchanges will go up, and the supply and the demand of the token should balance. But what will happen if there is a central exchange? Then arbitrageurs would just come in the way. So the arbitrageurs would just smooth the liquidity shock and sell any price. Suppose there is no limit to arbitrage. The arbitrager would just sell to any amount of the token to the customer in the token market on peripheral exchange. If the prices on the small peripheral exchanges is larger than the central exchange, and they will buy the same amount of token from the central exchange. So let's just compare the 2 results. We can see that the volume on the peripheral exchange actually increased. So that also means that the small peripheral exchanges will also tend to list the same token, and the price will be converged to the central exchange prices because of this arbitrage channel. And this is what our previous starlight effect state. And we also want to alleviate some concerns that our result is not driven by the arbitrage channel, for example, our attention channel. So we propose to another factor about the star structure of the price correlations and the star structure of the price correlations. So in the equilibrium, you could think that the equilibrium price on the small peripheral exchanges is the price of the central exchange plus some noise. So if we suppose that the noise is independent across each exchange, then the market correlation structure would appear to be a star correlation, and the price correlation between 2 small peripheral exchanges should be lower than the price correlation between 1 central and 1 peripheral exchanges. And that's what we just found. So next, finally, we want to do a volume decomposition exercise, because the motivation is that the core exchanges actually have substantial power to influence the market outcomes. And basically, besides for the volume that is generated on the central exchange, if they decided to list the token, there are other two effects that is generated by the large exchange listings. One, first of all, the trading volume on the incumbent small exchange will increase, and second of all, there will be more new entrants enter this market because of the large listings of the central exchange. So what we find is that for every $1 that the core exchange generates on their own exchanges, there are extra 0.7 and 3.6 of trading volume on the incumbent and entrant exchanges generated on these exchanges. So what we do is that we basically construct the log volume in 3 successive broad ways. So first, we only include the incumbent volumes, and then we include the incumbent and entrant volume, and the third is the incumbent, entrant, and central volumes. So we can estimate the 3 in this specification and recover the effect for the entrant, incumbent, entrant, and central exchange by just simply taking the difference between the theory equations. So that was our result. The top panel shows the 3 in this result, and we can show that the listing, the volume just got bigger and bigger if we use a broader successive way to measure the volume. And the bottom row just shows the propagation of this result. So the red line is the incumbent exchanges effect. So it is consistent with the previous result and effect. So the incumbent exchange would experience a spike increase in their trading volume and then sort of decrease very rapidly. And for the entrant, the green line could show, you could see that the effect for over time and be persistent, and it's also holds for the central exchange volume. But for the central exchange volume, the finance, the direct effect generated on finance is much larger than it is on Coinbase. So, so if we can calculate this leverage ratio to measure how much for each $1 trade volume generated on the central exchange, how much dollar can be generated on the incumbent and the new entrant exchanges. And so the main direct effect of this difference. So for finance, because their direct effect is very large. So for each $1 generated on Binance, they only create an extra of 0.7 trade volume, but for Coinbase, that's about 3.7. So this exercise just shows that the market shares or some direct volume generated by the large exchanges all essentially underestimated the role of the large exchange listings. So to conclude, so what we do in the paper is that theoretically and empirically, we found that cryptocurrency exchanges are complements rather than substitutes. We found that the large exchange listings is associated with a trading volume increase on the small incumbent exchanges, and also some new entrants are more likely to list the coin after the Binance or Coinbase list the coin. So what are the policy implications of this results? As I've already said that the small exchanges actually don't compete very effectively with the central exchange. So the small exchanges essentially act as the liquidity window to the large exchange liquidity. So they basically just charge very high fees and spreads for the customers on the free-flow exchanges. So one may argue, would the customers benefit more from centralization? If everyone just trade on a central exchange, the market would be much better. And the second implication is that the large exchange has a unilateral but unregulated power to shape the market outcomes. So as you say that the large exchange listings not only generate their own volume, but generate the volume on other exchanges. So they have capacity, and dual regulators may want to monitor this listing behavior and should the large exchanges justify their listing behaviors. So for example, the New York Stock Exchange don't have the power to decide what they are going to list. The SEC decide it. So from this perspective, I think we think the regulators should put in that should step in. Yeah. So that's all. Thank you very much. Because yeah.
Thank you. The content of this paper is given from University of Amsterdam.
All right. Hi guys, my name is Simon. I'm very glad to be here and be part of this amazing event. I think we've learned a lot in the past 2 days. It's my pleasure to now be tasked with discussing the paper by Junyi. I think he did a really great job in walking us through it and what he did there. When I received the paper, it still had a different title than the one we saw there. So this is literally the title of the version I received. Therefore that. One thing straight ahead, my very first remark, I believe is a very well-written paper. I do not consider myself an economist at all, though therefore I was a little like thinking, oh my God, will I be able to really grasp what they did there? But they wrote it so well, even for a layman, very easy to understand, I believe. So that is really a strength of the paper, if you ask me. Okay. Okay, there's a lag, all right. Then research question. So I was just lazy and I just copy pasted the research question directly out of the paper. How it's stated there is, how can a long tail of small exchanges coexist with deep and large core exchanges? Some results related to that, where then the large and small exchanges are complements, not substitutes. They repeat this argument various times. I think Junyi showed us very nicely how they came to that result. Also, when a central exchange lists a token, trading volume on these peripheral exchanges would increase. By the way, I'm doing my utmost to stay here in the very same terminology than they also do in the paper and in the talk to keep things concise, right? And lastly, this then would suggest that there are arbitrageurs who use the deep liquidity of these central exchanges for trading with the small exchanges. How do they do this? They study basically an economic model. And the model they built is there's one central exchange, and then there are various smaller, they call it peripheral exchanges. And these exchanges host like 2 types of users. One of them would be liquidity demanding users, and the other ones are the arbitrageurs. And these users, however, cannot switch exchanges. So there's this was particularly spelled out for the small exchanges. They are stuck to the one they start working with. And these arbitrageurs, what they're doing is they're then trading between the large exchange and the peripheral exchange to close the price gap. And I thought this, what they showed us then in empirical and also in the theoretical study is definitely interesting insights. However, I do believe there's more to the story than what they have done so far, and therefore I have a few suggestions for them. My first comment would be about the arbitrageurs and actual trading frictions, because the model implicitly assumes that there are no trading frictions, that these arbitrageurs can just move the coins around between these exchanges without any issues. Though it is already studied and also clear from the design of the blockchain that there is a certain settlement latency. Because what would happen if someone would actually want to move coins from one exchange to another one? They would first have to get them off the exchange back to the blockchain to their own account and then transfer them to an account of the other blockchain and then deposit, and then it will be only deposited on the other exchange. But blockchains don't act immediately. There is a latency simply involved, and for Bitcoin, roughly 10 minutes. And that is a long time if you're an arbitrage trader, right? This happens usually in nanoseconds. Therefore, we are dealing here with definitely limits to arbitrage due to the settlement latency. And there is indeed also already academic literature studying that. So I wanted to point this one out. So how Schoit and Voigt looked at that. They have this paper called Building Trust Takes Time, and they show they actually show there that there are these limits to arbitrage blockchain-based markets. I was just spelling out. My second comment is when I saw that these users can't switch exchanges, I was thinking, oh my God, this is a strong assumption, right? Of course, I'm fully with you. If you build like an economic model, you have to make assumptions which are not always fully representing reality. For example, what they're doing is they say there's like one large exchange and a bunch of smaller ones. Even in the empirical study, they use like various larger exchanges, but consider it as one large one. That is absolutely fine if you ask me. There are certain assumptions you can make, and they're easily then generalizable into reality. But this one I'm not so sure about, because it doesn't appear very realistic. Because when you actually observe the community, they do that. They switch between exchanges just around, and exchange also vanish, of course, from the markets. Some which were around in 2014 are gone since 18. So users do that. And why they do that is for many reasons. They offer them, let's say, improved or different services. They have different needs. Some like try to attract users by just do token giveaways with a native token they pushed out themselves. So literally offering them tokens to use on the own exchange then. Or there is simply deeper liquidity, which the users want to leverage on. Therefore, I believe also that somehow contributes to a larger number of exchanges out there. And I believe that should be somehow considered in the paper and also in the model, consequently, how this would simply affect how things go. Next comment was then on exchanges need these liquidity demanding users and arbitrageurs. But so that means then that these smaller exchanges have to do something to ensure that they keep or even attract new users, right? Of course, in the present model they just say the user base doesn't go away; they're just there. But again, not very realistic if you ask me, because but there is like one often stated narrative in crypto, which is that small crypto exchanges compete with larger ones by simply listing smaller coins first. And this I just screenshotted from Junyi's paper. It's basically a larger version of the two plots he showed us before. And I think the solution is already actually in there. So what Junyi and his courses did, they basically focus on that part in all of these plots. So we say when the large exchange lists, then you see a spike of listing on the peripheral exchanges and so on through, right? However, I think the really interesting part is here. Fair enough. Here's much lower probability mass, so much less exchanges list a coin, but that's the point. These ones list them first, and by that attract users who are interested in that coin, because they can't go to what is it, Coinbase, they have to go to some other one. And that's how they simply get new users, and that contributes then after all to this mass network where we have so many exchanges. Because we have latency in the listing also on the exchanges. And I think this is something worthwhile looking at, which would, I believe, very much contribute towards the main research question spelled out. An inherent assumption of the model is also that exchanges are essentially the same. The only thing they're differing in, as far as spelled out by the model, is that whether people trade and then the deepness of the exchange, trading volume, you name it. However, in reality, crypto exchanges are not the same. Not at all. What I did here, because it's a bit small, I went to CoinGecko. I went to their trust score ranking, because these platforms figured out a few years ago that there are a lot of fraudulent exchanges out there. So various platforms started publishing trust scores. So does CoinGecko. And I just told them, just show me what's happening in the United States. And it gave me in some 14 crypto exchanges. A bunch of them are already defunct, actually, but still listed on CoinGecko. So here, everything under 10 is actually defunct. So there are only 9. And then I get me a trust score. And well, by that, I think we already see that these exchanges are simply not the same. There are qualitative differences between them, and the user really has to be careful of where they go, depending on that. So an exchange, which is listed here as very untrustworthy, has a little bit tougher to attract new customers, so has to do something about that. Therefore, I think since exchanges are not the same, and that goes back to the research question, why are there so many out there? This is something which I believe should somehow also be reflected in a model or in a study, how that actually influences things in the end of the day. When I already read the abstract, there was one comment which completely dazzled me. There was like stated there are more than 1,000 exchanges out there for cryptos. And the numbers seemed extremely high to me, even though I could somehow believed it, to be honest. Again, I did the same thing. I went to CoinGecko and also to CoinMarketCap and see how many exchanges do they follow at the moment, and it's less than 1,000. So I looked a bit more into it. I also found in the paper the statement that there are 150 exchanges, crypto exchanges in the US, and only 16 equity exchanges, actually, this kind of comparison. By the way, I consider this actually more like a minor comment, not like a major comment. So on CoinGecko, I found they have like 748 and 14 for the US. So I wondered where this number came from. So in the paper, Junyi and his co-authors give like the link to a website where they got this number from, apparently. And indeed, on this website, when you just key in United States of America, it gives you 166 crypto exchanges listed. Well, but there are also different types of them. So I just put it on exchange. And this website also lists the entire history of what was ever there. So here's another one where they check the website status, literally offline, online, and like currently defunct and so things. So I just put it to online, and then they actually gave me only 44 entries. This is so therefore I just wanted to caution you a little bit, so not like overstate how much is out there. There are still a lot out there, just to keep the numbers straight. Right, and lastly, I was not so sure if it's the right thing to actually compare equity and crypto exchanges so directly to each other, literally treat them in this way. The more and more I thought about that thing, because equity exchanges are inherently different from crypto exchanges. They have a long-lasting history. Sometimes their history literally goes back hundreds of years in existence, and they are regulated, heavily regulated. Crypto exchanges, on the other hand, have like really a startup flair. And they are fast developments, like they come constantly up with new things what they can offer. So I thought, isn't there something which we know from the traditional markets, which is the kind of that? And my thought came to me to trading apps, which I think are probably more alike in comparison with crypto exchanges, because also they compete for customers over different services, costs, or products simply offered. Things you can probably not trade via the trading app of your very bank. So that was like the last thought I simply had, that probably would make sense to look a little bit into that literature or into that comparison, what can be done there, and simply view these large and small exchanges more like service competitors in the sense of exchanges and trading apps, rather than classical competition between exchanges. Just a random thought. Maybe you guys want to look into that. Dan, thank you so much. And yeah.
Thank you for very detailed and big me. What happened to Jinfei? Did you also we let it?
Also, yeah, so unfortunately, Professor Jinfei should step out for some reason. Okay, so yeah, so first, thank you for Professor Simon's very detailed and constructive constructions. So I have it well written, and basically I think the main result, especially the settlement latency, is something that we should think about very carefully. And other suggestions are also very constructive, and we should be more careful in the paper. Yeah, I think I can take some questions, but currently.
I completely agree with the second comment. And also the third, maybe the small change in listing the small coin first, and then wait until one day, like the crypto like the Yang or coin that also release the coins initially created on their exchange. So I wonder, following that logic, what if with this theory of the case where you have the incumbent interest, right? And then the central gate change. What happens if the small chain, there's no incumbent, right? The small chain follow the big chain. We do still see, say, if big chain is the one, and soon after the small chain, several of them leads that, you see a big spike as well.
Yeah,
So,
yeah, so that's definitely a very good point. So I think we should look at carefully about the heterogeneity about the coins that is listed by the central exchanges. For example, some exchanges have already been very popular, while some others, yeah, so the market scale is quite small. So yeah, so that I think that could make a difference, and we should see whether there is a spike in the following for these small coins. Yeah.
No, just a question about data. I don't know the history at all, but I later remember this paper by Junyi and one of the students. Now they're talking about there are also trade that are fake, not real trade. Or maybe there are technical real trade, but between you and your friend or different account by the same guy on the exchange. So I'm just asking about quality of the trading model data that you need to be careful.
Yeah, so the quantitative data is pretty, we need to be very careful. As you mentioned, the Professor Kong and his course that mentioned the data volume. So I think I can give two answers. The first answer is in a very short period, about 20 days. So the quantity, the data quantity should be at the same level, right? So there may be some cases that the crypto exchanges fake the volume after, but don't fix the volume before the large exchange listings. And the second thing that we actually do some robust tests to restrict to the exchanges that are regulated exchanges also, so they use in their paper, and we still found that the results are quite robust.
So maybe one last comment then. Also about this difficulty, the trading volume, the small exchange on the listing and the big exchange. So even if the small exchange is already what we call incumbent, and the coin are already listed there, I don't know whether you have the data to see who drives the trading volume spike. Is it you in that? On the small exchange, or it shouldn't be existing in that way.
Yes, so yeah, I think the intuition is that the before central exchange list the coin, the market is not very quite efficient. So the price dispersion across the exchanges is very high. So when the central exchange comes in and there is a liquidity kicks in, so the arbitrator would do this to smooth the liquidity across these exchanges. Yeah, so I think the arbitrage channel is where the new volume comes in. Yeah.
Sure, that I see that point, but arbitrator technically can go to the small exchange volume, right? So I was thinking more like the listing may indicate or attract more attention. People think, oh, this is going to be popular, there's going to be cycling bubble, so they come somehow to the small exchange. You say, why not big exchange? Because maybe there are some twin, regulatory twin, for example, twin. They can only go to some small exchange in their country. And then
yeah, so the attention channel is actually
basically how much is due to arbitrage, how much due
Yeah.
to kind of increase speculative or attention. That's driving demand on the referral chain.
Yes, so the attention channel is actually a competing alternative one that can explain the results some partially. So we partially alleviate this concern by showing that the price correlation across the exchanges is bigger for the pairs which has one peripheral exchange and one central exchange. So the correlation between one peripheral and one central exchange is larger than the correlation between two peripheral exchanges. So that's what the information channel can get. But yeah, so the attention channel is quite important, and I think we should have more direct evidence into how the arbitrage really works. For example, we could maybe have some on-chain data in the future to see whether the arbitrage really is there.
Thank you. Let's move on to the last element. The state of the last.